Well, hello everyone. Thank you for tuning in. Today, I'll be going over our mid-year 2020 investor update, and that starts right now. Welcome back. I'm John Williams, the owner and advisor at Ironwood Wealth Management. Today's agenda will be very straightforward. I'll first share a brief investor update, then I'll discuss some ideas and strategies that you might want to consider. Before I get to today's presentation, I want to take a minute to remind everyone, please stay safe and please try to stay positive. You know, we're all in this together. We're all still experiencing very challenging and unprecedented times. But remember the words of the famous poet Virgil, who said over 2,000 years ago, the greatest wealth is health. I think it's always important to review that there are 5 key areas of financial planning: preservation planning, retirement planning, tax planning, estate planning, and also investment planning. And although today's presentation is mostly about the equity or the stock market, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make, not just on one of these areas, but all of these areas for our clients. Charles Dickens wrote a very famous novel called A Tale of Two Cities, and it started out by saying, and I quote, "It was the best of times, and it was the worst of times." Well, the first half of the year has been a lot like that. After making all new highs, the virus hit, and in less than 3 weeks, in March, the S&P fell from a 52-week high to a 52-week low. That decline set a number of records, but for those investors that stayed the course, the second quarter of the year rebounded substantially. At the midpoint of the year, on July 2nd, equity markets were very close to where they initially started at the beginning of the year. Second quarter results were very strong, and investors who stayed the course were rewarded. The Dow Jones Industrial Average posted its best second quarter performance since 1938. The S&P 500 ended with its largest quarterly gain since 1998, and the NASDAQ, which is an index that is heavily weighted in technology stocks, made an all-time high during that quarter. We like to say that panic is not a plan. Investors who panicked and maybe sold some things might have missed on some of those strong returns. And although equity markets have moved significantly higher at mid-year, investors still faced a number of issues. Bond yields that remained very low, gold prices that were rising, unemployment that was rising, oil prices that had rebounded but still down year to date, Chinese surveys showing factory activity had actually risen to a 3-month high, and some experts warning about losing control of the virus outbreak. The Federal Reserve lowered the federal funds rate in mid-March to a range of 0 to 0.25%. Fed Chairman Powell stressed that the pace of the recovery is dependent on the path of the virus. The central bank repeated its comments from their April meeting when it said they expect to maintain that range until it is confident the economy has weathered the events and is back on track to achieve maximum employment and price stability goals. The chairman also said, "We're not thinking about raising rates. We're thinking about providing support for the economy, and that may take some time." Bankers also projected at that June session the economy will likely shrink this year by about 6.5%, then next year go up 5%, and then up 3.5% in 2022. Both of those are above the economy's longer-term trend. The all-time low for interest rates is effectively 0, and the Fed has only lowered their rate to that level twice, once during the financial crisis in 2008, and now again in 2020. You know, I firmly believe that everyone should have safe money that is set aside as a rainy day fund. But for the funds that are above that amount, what do you think the potential true cost is of overly safe investments? Well, according to Barron's, the average bank money market rate on June 29th of this year was 0.12%, and the average one-year CD was 0.4%. For many investors, their longer-term money, these low rates might not help them meet their goals. Therefore, equities could be part of an overall diversified and balanced portfolio. Moving on, although the equity markets are not the economy, many experts conclude that the stock market is an economic indicator for the U.S. economy. Their view is that equity markets reflect how well all listed companies are doing. So typically, if investors are confident, they will buy stocks. So let's take a look at how the economy was initially affected by the virus and how it's now recovering. As the chart here shows, after a decade of mostly growth, the first quarter gross domestic product, or what they sometimes call GDP, was negative 5%. That was the worst we've seen in well over a decade. So how we recover from here is going to be very crucial. I always feel a knowledgeable investor is the best investor. So let's quickly review some of the more common economic recovery scenarios that are being talked about today. They're usually referred to as a V, a W, and an L. That's because that is the shape the graph that they have looks like. In a V-shaped recovery, there's a sharp decline and then a very quick rebound. A W shape is a double dip recovery, and then the L shape is a sudden decline and then a weak recovery. Barron's magazine, on its July 6th edition, had an Analyst Roundtable that offered 3 potential second half directions. They were a worst case scenario that includes slower progress for companies, trouble fighting the virus, and also rising unemployment. Their base case, or their most likely case, includes everyone getting through this virus, the Federal Reserve continuing to be supportive, and the economic situation improving. Their best case scenario was for the worst of the economic injury to be behind us at this point, a vaccine being approved in the near term, combining that with return to economic growth. Obviously, no one can predict with certainty where things will go, but we can probably all agree it's going to be very interesting. While prior equity market performance is definitely no assurance of present performance or future performance, as the chart here shows, after World War II, bull markets have been far more robust than bear markets, and they've lasted considerably longer as well. While every market decline is definitely unique, over the last 70 years, the average bear market has lasted about 14 months, resulting in an average loss of about 33%. In contrast, the average bull market has been 72 months, or more than 5 times longer, and the average gain has been 279%. Please keep in mind that for now, volatility in the markets looks like it has definitely reemerged. After several years of some very limited volatility, first half of this year, investors have seen more up or down days of 2.5% or more than in almost every year since the 2008 financial crisis. So the question is, how should an investor move forward at this point? Well, keep in mind, one of our goals is to look at all the situations and guide our clients with ideas. One of our main goals is for us to consistently search for opportunities. So I want to quickly review a few of them today. The first is required minimum distribution, sometimes abbreviated as RMD. For 2020, retirement accounts do not have to take a required minimum distribution. If you're someone who has already taken an RMD this year, you can return that money without tax consequences or penalties on or before August 31st of this year. If you've already taken that distribution and you're looking into this, please just give us a call and we'll be glad to walk you through. Maintaining a properly designed and well-diversified portfolio is always important. Also, now is a good time to look at your portfolio and consider any rebalancings that may need to be performed. And also, please look carefully at possible Roth IRA conversions. I think it's very important and something that is very beneficial to many people and should be thought about. I think it's also a good idea to continue to review if your risk tolerance has shifted. That's always an important subject. Also, to review if any of your time horizons have changed is always a healthy practice. Now is also an ideal time for investors to re-examine their core investment philosophy and strategy. Legendary investor Benjamin Graham, who by the way was Warren Buffett's mentor, was quoted as saying many years ago, individual investors should act consistently as an investor and not as a speculator. So I want to review a main difference between what it means to be an investor and being a speculator. And one of the key differences between them can be time frame. Investing is generally buying and holding an asset for the long term, assuming it's a good investment. Speculation, on the other hand, is typically taking high risks that can include trying to make large returns over a shorter period of time. Now, thinking long term is still the way to look at equity investments, in our opinion. Typically, the most successful investors think and act for the long term. It's near impossible to predict exact market movements. However, we believe it's possible to prepare. Equity market volatility is back, and that can be scary for a lot of people. That's why we always have said, be prepared, not scared, and proceed with caution. So as a recap, what are some of the key takeaways for investors at this point? Well, the first half of the year, it's been a pretty wild ride for equity investors. Extreme volatility has definitely reemerged. Your health should always be a top priority, and you should continue to focus on your personal goals, and please call us with any concerns. What can you expect from us? Well, as always, you can expect regular communication, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. Please remember, your health and well-being is one of our highest priorities. We appreciate from the bottom of our heart the trust and confidence that you have placed in us. Please also remember, we would like to help others this year. In fact, I would love to add a couple of your friends to our newsletter list so they too can benefit from the valuable information that we are regularly putting out. Please let us know the names of anyone you believe could benefit. Thank you very much for watching our update, and I hope you stay safe and healthy. Please have a great day.